The highest risk right now is in actually the stock market. Now, I think real estate's risky too at this level. Everything's, I would say we're in a period where we call it everything speculative, and that's true. Almost everything speculative. Private businesses are selling for speculative prices, but the markets are selling for prices that actually have never existed before. And the problem with that is that when you get to this point and everybody keeps on speculating and keeps on working, they just speculate more. So that's where we feel like we are and at this point, because I could take any measurement of that, price to sales on the market or forward price earnings. I could price to book value and just look at all the speculative activity, and as well as the number of companies. I mean, there's so many companies that are at these exorbitant prices that are losing money or not making any money. And so I think people, they've just gotten complacent. And I think the biggest risk right now is in that area. But today you have a tremendous amount of companies that really have no value. They're just trading. I mean, look at the last two electric car companies that have come out here. If you look at Rivian and Lucid, I mean, here are companies that have nothing, and yet they have these billion-dollar market caps or more. And that's what we see today. We see this unbelievable amount of buying into things that don't have any value at this point. I'm not saying they wouldn't later on, but if you remember back in the 99, early 2000 era, you had a lot of companies that were selling. If you look at AOL and Yahoo and those companies, I mean, those companies lost 80% of their value, 85%. Were they still around afterwards? Yeah, they were. But they really weren't worth the money. And that's what I'm saying. Yes, there'll probably be a number of these companies around. I think a number of them won't be around, but I think that's where we are today. I do. I would guess that we'll have some sort of a bear market within the next 2 years. If you ask me a yes or no question, I would say yes. Well, usually from this level, if you look at your standard deviations of valuation relative to where the market is, and you just go back to an average of where it should be, that's probably right now somewhere between a 40 and 50% break. Now, I'm not predicting it's going to be 50%, but I have to tell you, it wouldn't surprise me, only because you go back. Everybody believes right now, they think you can't go back to the norms. Well, you always go back to the norms eventually. Yeah. It might not be this year or next year, but that's what happens in investing. That's why it works the way it works. And so at some point in time, you'll go back to some basic, those sorts of valuations. That doesn't necessarily bother me, because I think people need to realize if you have liquidity in those times, that's where you really make a lot of money. And I think we always look at it as an opportunity. I think the biggest thing, David, is this. If you look at the people that have come into this business over the last 12 to 14 years, they've come into a situation where they all buy index funds, they all buy exchange-traded funds. They what I call plug and play. They buy 10 assets and say, hey, just don't worry about it. It's great on the long run and everything will be fine. Well, the last 10 years, that actually has been true. I can't argue with it. However, when you go into a bear market that lasts a year and a half or 2 years, it's cruel. It takes down the best stocks. It takes down the worst stocks. It takes down everything. You can have the best stocks on the board, and bear markets take them all down. And the thing that they probably wouldn't understand in that is that it wears people down over time. And the people that have been around the last 12 years or so haven't had a chance to be worn down yet. So what happens is they'll get that, in my opinion now, they'll get very frustrated, and their investors will get frustrated because they didn't have any liquidity. So many of them today, we see portfolios all the time, zero liquidity, and there's no insurance policy whatsoever at something going wrong. So I think that'll be the biggest problem for those people in that situation. Is basically, what is your choking point? Now, everybody, no matter how risky they are or conservative they are, has a point to where they want X amount of dollars not to go any further. No, there is a point. Even the most risky people we know can get shaken up if they lose enough money. And so what happens is, I tell everybody, look, whatever is in your psyche, there's a dollar amount in there that says, okay, I want this amount of money to always be, and we call it, we have an idea. We have base capital and we have investment capital. And we always say on this base capital side, there's a certain amount of money that you need to keep out of the markets. You need to keep it very, very solid. It's not volatile at all. That's the number that will allow you to go through the ups and downs of the market with your investment capital and not shake you out.
Yeah.
If you have everything in the market all of a sudden and you think, gosh, I never thought, I've had people tell me this before, I never thought my capital would go down to this level. Well, it's because they didn't have, you have to be able to live to play another day and survive.
Yeah.
And I think that's the key point in investing, is that if you get in a position where all of a sudden the market's controlling you because you've hit that point that where, hey, you know what, I can't take it. For young people, I think they always should have some money there. They can have more money in the market because they put more money in all the time. But that's what we look at. I think you have to get to that number, and if you can realize what that number is, okay, that's a number I want, then everything else will work for you. Is one, if you're a person that's going to be having money to put in every year, the rest of your life, you could have more in the market, and you could be wrong because you're going to be averaging out every year if you're going to put more money in. For so many investors, though, they have a lump sum of money. They can't do that. This is what they have. They retired on it. They sold a company. Something's happened. But for somebody in the situation you're speaking about, the only thing I would say is this, and that is, if that other 90% got cut in half, I'll use that example.
Okay.
Then ask yourself how you would feel. And if you